Welcome back to the Pro Ticker Podcast, your Friday morning edition, covering major financial magazine headlines, everyone.
Good morning.
It is Friday, December 19th, 2025, and we have been poring over a significant stack of financial reports, analyst notes, and headlines. And they're not just signaling turbulence, they're pointing to some genuinely seismic shifts.
They really are. The sources we've compiled, from major financial magazines and detailed reports, they paint this picture of extreme divergence this week.
Divergence.
Yeah.
That's a good word for it.
Yeah. I mean, you have a major central bank finally reversing 3 decades of policy, and the market almost shrugs. Then the world's largest equity market rallies hard, cheering on data that, as we'll get into, many top economists think is fundamentally unreliable.
A statistical mirage, I think one called it.
Exactly.
So that's our mission today. We're going to try to cut through some of that noise. We're focusing on a trio of massive global shifts. First, the Bank of Japan's historic, but let's say confusing, policy pivot. Second, that suspicious U.S. inflation data that sparked a huge rally, but, has a huge asterisk next to it. And third, the record corporate debt that's fueling this AI infrastructure boom.
And we'll tie that all together by looking at how global supply chains are aggressively reorganizing and what geopolitical moves are happening right before the year-end break.
Okay, let's unpack this. Starting with a policy shift that literally hasn't happened in 30 years.
Right.
And one that has massive global implications.
Correct.
The Bank of Japan. So the Bank of Japan, the BOJ, they delivered a truly landmark move this week.
They really did.
They unanimously raised their benchmark interest rate by 25 basis points, bringing it to 0.75%.
Which is the highest level Japan has seen since 1995.
Since 1995.
Now, the move itself wasn't a total shock. Reuters had polled economists. They were mostly expecting it. But the reason for it just shows you how far Japan's monetary policy has lagged, global reality.
Right, because inflation has just been so sticky there.
For 44 straight months, core inflation has been at or above the BOJ's 2% target. It was 3% again in November. They had to act.
And here's the core paradox, the thing every financial desk is talking about. They make this historic hike, and what happens? Japanese stocks actually jump. The Nikkei went up 1%.
Right, and bond yields soared. The 10-year yield hit 2.022%, a high we haven't seen since 1999.
So all signs of confidence, you'd think.
Except for the one thing that really mattered, the currency.
Yen.
The Japanese yen weakened. It fell against the dollar immediately, and then it weakened even more after Governor Ueda started talking. A move designed to strengthen the currency made it weaker.
So if the whole point of raising rates is to attract capital and boost the yen, and you get the opposite, what gives? Why did traders just ignore the hike?
It all came down to forward guidance. Or, the lack of it. Traders were looking for a clear, strong, hawkish signal about the next hike, and the one after that.
And Ueda didn't give it to them.
He did the opposite. He started talking about the theoretical neutral rate and said it's somewhere between 1 and 2.5%. By saying the current rate is still at a significantly low level, he basically told the market this isn't the start of some aggressive news cycle.
So he's saying, don't worry, we're still significantly accommodative.
Exactly.
Even with this historic move. So the market hears that and thinks, okay, this isn't serious. This normalization is going to be incredibly slow, maybe a hike every 6 months. We're talking years to even get to 1.5%.
Right. It suggests they're prioritizing stability over actually fighting inflation aggressively. They're normalizing because they have to, politically. People are angry about the cost of living, the weak yen.
And the Ministry of Finance is so worried about it that they've been dropping hints they might actively intervene over the holidays.
Yeah, it's this massive pivot that, in the end, still feels kind of underwhelming to the global market.
Speaking of government actions causing complications, let's shift over to the U.S. We saw stocks rally big yesterday, snapping a 4-day losing streak. The S&P was up almost 0.8%, NASDAQ jumped 1.4%.
And the catalyst was the November CPI report, the Consumer Price Index. It showed inflation cooling to an annual rate of 2.7%, which was way below the 3.1% forecast.
Sounds great on the surface.
It does, but this is where we need to be really skeptical. Can we actually trust this number? Many economists are calling it the data nerd equivalent of the emperor has no clothes story.
And that all stems from the government shutdown back in October.
It does.
So for the listener, what did the Bureau of Labor Statistics, the BLS, actually fail to do?
Well, put simply, the shutdown meant they couldn't do their normal surveys for October. Specifically, they couldn't get fresh data for the shelter component.
And shelter is a huge part of the CPI.
It's a third of the entire index. It's massive. So because they didn't have fresh data, they had to use carried forward numbers. They essentially just plugged in old assumptions from September into their November calculation.
So they basically assumed zero inflation for housing in some major cities in October.
That's the argument from economists like Jason Furman at Harvard. He says it was likely a big judgment error. If shelter costs were actually still rising in October, which is likely, then the official 2.7% CPI number is significantly understated. The real number is probably higher.
So the market rallied hard on a number that might be a complete mirage.
That's the risk. The Federal Reserve could be making policy based on faulty data. It means the December and January reports are now incredibly important because they'll be the first clean numbers we get.
And if that number snaps back higher, the market reaction could be pretty brutal.
It could be. The market is pricing in rate cuts for 2026 based on this noisy data. If the mirage disappears, that narrative could fall apart very quickly.
Now, there is one part of this that does seem real, and that's falling gas prices.
That is real, yes. Gas prices are dropping, and that's putting actual cash back into consumers' pockets, which we can see in some of the retail numbers.
Okay, so let's link that uncertainty to the corporate world, where the big theme seems to be massive investment, funded by massive debt.
What's really fascinating is just the sheer speed of this infrastructure build-out for AI. Global data center deal-making hit a record $61 billion in 2025.
$61 billion.
It just reflects the insane energy and infrastructure demands of running these large AI models.
But the alarming part in our sources is how this is being financed. The debt issued to support all this construction nearly doubled this year to $182 billion.
It's not coming from cash flow. This is borrowed money on a huge scale, and it's definitely sparking concerns about an AI-fueled bubble.
Right. And you see the hyperscalers like Meta and Google issuing enormous amounts of debt. Meta's taken on $62 billion since 2022, and almost half of that was just this year.
And the key shift is that they're tapping private equity and debt markets instead of funding it all themselves. They're offloading the financial risk, which feels a little like what we saw back in the telecom boom in the early 2000s.
And the market is so sensitive to this. Look at Oracle. Their stock dropped 5% on just an unconfirmed report that a backer might pull out of a $10 billion data center project.
It shows how tied this whole thesis is to the debt market's willingness to keep the taps on. But speaking of Oracle, they did get a big win this week on another major story, TikTok.
Right. CEO Shou Chew confirmed they're moving forward with binding agreements for a U.S. joint venture, separate from ByteDance.
And Oracle is leading that U.S. investor group, along with Silver Lake. Their stock jumped over 5% pre-market on that news. The new entity is supposed to control all the data, content, and the algorithm security.
But there's a catch, isn't there?
There is. It's a big one for the national security folks. The deal still allows ByteDance to license its core AI recommendation algorithm back to the new U.S. company, so the secret sauce is still coming from China.
So it's a compromise that leaves some critics very worried about continued influence. Okay, so moving from the mega caps, where did active managers find any success this year?
Well, according to Pivotal Path data, equity-focused hedge funds actually had a great year. Their equity sector index was up about 22.7%.
That's very respectable.
But the real standout, the defining success story of 2025, was healthcare-focused funds. They returned nearly 36%.
36%. That's an incredible outperformance. What on earth drove that?
It was a perfect storm of very specific, non-macro factors. You had the new Medicare price negotiations creating clear winners and losers. You had big pharma companies facing patent cliffs, which created great shorting opportunities.
And I'm guessing the weight loss drugs.
And most critically, yes, the GLP-1 weight loss drug arms race. All of this created what managers love, which is clean dispersion. It wasn't about the market. It was about picking the right stocks based on clinical trials and product pipelines.
It was a stock picker's dream, it sounds like.
It absolutely was. And some other winners were funds targeting Asia, up 19%, and tech and media funds up over 17%. So 2025 was definitely a year where if you're in the right niche, active management really paid off.
And that focus on specifics really contrasts with the big, messy uncertainty we're seeing in global trade.
It does.
Let's wrap up with a look at supply chains and policy. Jim Cramer was pointing out the resilience of the consumer, with companies like Darden and Texas Roadhouse doing well, fueling a potential Santa Claus rally.
And that consumer strength seems to be happening even as these huge global trade shifts are underway. The CNBC Supply Chain Survey shows sourcing continues to move decisively away from China.
Right, because of tariffs and geopolitics.
Yeah.
And we're seeing these new hubs pop up.
Exactly. Southeast Asia, Vietnam, Malaysia, and then Mexico and Turkey for nearshoring into North America and Europe.
But it's not just about moving factories. The real differentiator is technology.
Absolutely. The survey found that 100% of respondents plan to increase their use of AI in logistics. We saw an incredible stat from C.H. Robinson showing how AI agents can generate price quotes in 32 seconds
Wow.
and take an order that used to take 4 hours to process and get it done in 90 seconds. That's how you offset the costs of moving your supply chain.
That speed is the only way it works. Okay, beyond trade, a few quick policy hits. In Europe, the EU approved a massive aid package for Ukraine, 90 billion euros.
And the key detail there is how they're funding it. They're using joint borrowing, not the 210 billion euros of frozen Russian assets.
Right.
That tells you there are still serious legal hurdles to actually seizing and using that money.
I see. And then a symbolic trade gesture from Toyota.
Yeah, they announced they'll start shipping 3 U.S.-made models, the Camry, Highlander, and Tundra, to Japan in 2026, explicitly as a gesture to improve U.S.-Japan trade relations.
And finally, a real example of supply chain decoupling. The Chinese unit of a company called Nexperia secured its own local supply of critical chips for electric vehicles from Chinese firms.
Right, after a dispute with its Dutch parent company. It's just another sign that this push for localizing critical manufacturing is really hardening.
And quickly, here at home, House Republicans committed to a vote on banning members of Congress from trading individual stocks.
But the sticking point remains that their proposal likely won't include the executive branch, which is a non-starter for Democrats, so probably not going anywhere soon.
Okay, so to sum it all up, a massive but maybe underwhelming policy shift in Japan.
Highly dubious but market-moving data in the U.S.
And these intense global pressures driving corporate debt to record levels and forcing a total reorganization of trade flows. It's been a wildly divergent week.
It really has.
For our final thought, we want you to consider this. We just talked about how some hedge funds did really well, but there's still an extreme correlation between overall hedge fund performance and the broader market. So given that, how should you prepare if that noisy U.S. inflation data, that mirage we talked about, truly is an understatement, and it leads to a sudden, painful market correction when the clean numbers finally arrive next year?
That potential data snapback risk is, I think, what we all need to be mulling over this weekend.
Indeed. We'll see you on Monday morning with new headlines from major financial magazines.